And welcome everyone, I'm Sino. Let me take you through a session of backtesting here, which I had yesterday night, which was basically this day. So we're looking at the chart of the dollar index on the daily time frame, because again I'm a swinger. That's where we want to look at anyway, the daily, and then enter our trades on the 4-hourly. So we look at these big swings on the daily time frame. So we started the visible portion right here, which was like the most recent flat. And anyways, I'm using a voiceover. So I added the Donchian channels to look for the reversal on the lower boundary of the Donchian channels right here. So most of the time, if I'm buying, I want to buy above the Donchian average. So we also added the averages here. So we're still trading below them, which was not good for entering in terms of like real-time trading. But then because it's higher time frames, which was still good. So I wanted to look at the most recent candlestick. It's a bullish engulfing, and then the 200 EMA, which is red, offered the support that we needed. So going to the monthly, again, you can see here a bullish engulfing as well as a morning star. We closed just slightly above the Donchian average, and then the 50 EMA offered the support that we wanted. So again, we're back testing, but we're still looking for evidence because we're treating it as if we're trading. So on the quarterly, we see a bullish engulfing, and then again going back to the weekly, we see that bullish engulfing. So confirming the wave count, we want to use a line chart. So I use a variety of indicators. This is called the Williams percentage range, and this is basically the red one is the 5 period, and then we normally use the 20 period for big swings or long-term corrections or major corrections, as some of you may call it. So we see an inverted head and shoulder pattern, which is indicating that we have a move possible to the upside here. But then when I checked the MACD, I didn't see anything including divergence here or reverse divergence, as some of you may call it. But then going to higher time frame, which is monthly, I saw what we call a zero line reversal here. And then one of the things I wanted to check was actually the RSI or relative strength index. There wasn't much to check except that we're trading between the 50 and 40 levels, which is a good level for support on a bullish market here. And then other than that, there wasn't really anything. So I did like look at it, there's like a wave count possible. We're still trading below the 45 EMA, which we normally use to highlight the support, the trend. And then we saw here what we now know as divergence, sometimes negative divergence. And then I check the Bollinger Bands. Normally, I like it when we're trading outside of them a little bit, but there wasn't really anything on the Bollinger Bands except the support level, also the fear and greed, nothing really. So I went back to the wave count. As you can see it in ABC to the downside, and we're looking here for a greater move to the upside. Highlighted my zones of support and resistance, specifically the resistance level. So I was expecting to use the balance entry here. So if you don't know it, just go and check out my trading plan. This was like supposed to be a zone whereby I was expecting, a push to the downside the moment we hit it, so that we can enter at the point where we have a star. But unfortunately, we missed out. So my conclusion based on this entry was that if I was waiting for like a pullback, I was going to miss out on this trade. So I had to like reformulate the way, of finding, like a better level of entry per se, because again, I missed out. And look at like, the Fibonacci retracement levels here. It's like 23.6, which is not even like a level I would consider to say, okay, wave 2 is completed, given that you normally see that 50 to 61.8, like on a daily basis, I would say. So I thought, pending stop orders would be like a better way, specifically, like a buy stop order in this case at that 101.839 level. So went back, and then I had to assess, like the risk. So the best level, like for the take profit targets would be the peak of wave B right there. I think around $106 within like, like if you look at like the right side of the scale. But look at the risk to reward. It's not so appealing. So I thought, how about, backtesting further and look for the point whereby I would get say, you know, like an earlier entry than this one, because again, I don't like taking trades that have a risk to reward that is less than, you know, like a 3:1. So in this case, I think we had about 2:7.6. I think 2.76:1, which is like still less than, you know, the one that I normally want to see. So we had, you know, things like the divergence here that we like to see between wave 3 and 5, which is a good confirmation sign. But look at our, you know, our wave 2, man. It's like not really appealing. So, but if you look closer now, what I saw was that we had actually these candlestick patterns, which we know as 3 white soldiers. If you look at them, you know, they are increasing in size as the market pushes higher here. So I just placed my stop loss just slightly, you know, inside the invalidation level, because again, by the time the market tends to reach that, chances are it's going to breach anyway and continue to go down. So I placed my stop loss there. Even the risk to reward is better. On top of that, the entry is a bit earlier. So again, using candlesticks here was a wiser choice. So again, you know, we just entered one trade, which is not really how I would do it, but I was just testing something. Because again, if you look at like this wave 1, it was a bit more of what we call a kickoff wave, although it was not as powerful, but it was like, you know, extended. So it's a typical thing for like a kickoff wave here. So anyways, you know, looking at the candlestick patterns, I concluded that based on this scenario, because I've seen like the 3 white soldiers a couple of times over now, and they tend to be leading when it comes to say like a change of a major trend. Check the line chart, you know, to confirm the wave count, and look at that. What do we see? A flag pattern. So if you are a fan of chart patterns, you will know what we're talking about. We're not talking about a flag pattern. But then if you look at just the Fibonacci retracements, you know, it's not so convincing for wave 2. But then again, you know, given that the DXY had been declining for a while, we had to see some power here. So I thought, well, why not trade this move to the upside or continuation, you know, just using the chart pattern style of trading, that is the entry as well as the stop loss. And then in terms of target, still use the high of wave B as, you know, the high, like whereby we take profit. But still, the risk to reward was not convincing for me. And on top of that, this trade would be what we call a scaling trade or a test trade. But if you looked at the candlestick following the breakout of the flag, you know, it had momentum. So normally what I would do again is like, you know, use a buy stop order. You know, the moment we breach the high of that black candlestick, you know, the first one to the downside following the first decline. So again, we go higher here. I mean, if you look at the peak of wave B, or that is the origin of wave B, it's normally where a lot of shorts stop losses for short positions are. So again, you know, liquidity, you know, for the buyers. Hence, I thought like this would be a good initial target position here, or target level. But then I am not really using support and resistance. My primary methodology is still the wave principle. So I have to make sure that I check the internal wave count. Hence, you can see here right now, I'm still trying to find a way to maximize the profits as much as I can. Because, well, these levels are good, but then the most definitive thing about my methodology is that I use the wave principle. So look at how the risk to reward now just improved by looking at like the tool that we use to measure it. So that's probably now our third wave. Now, if you saw our wave 1 is still longer than our wave 3, although we didn't measure. So I thought, well, our wave 2 was a bit, you know, like brief. So I would expect our wave 4 to be a bit deeper. But look at the 5 waves to the downside. I probably like that's still wave A. So I thought, and then you know that corrections are normally in threes. So I was expecting, you know, like the last push to the upside, to the downside before we continue to the upside. So I highlighted with that level right there a possible entry point, again using the Kennedy entry technique. So we know that the Balan method uses the Fibonacci levels. So in this case, I will just show it to you how you normally use the Balan method in order to enter for wave 4. So we measured right here. This was like, you know, us trying to aim for the target of wave 5. Now that 0.618 sometimes is normally, you know, limited or brief, especially if your fourth wave was sort of like deep, so you'll end up most of the time leaving profits on the table here. So we used at some point, as you can see here, what we call the Balan entry, just normally, you know, a breakout sometimes, or sometimes the Fibonacci levels. So in this case, we used like a breakout of that, you know, like trend line, and then a close outside again. What do you see? 3 white soldiers, just like you did earlier on. So we sort of like use the tool that we use for the risk to reward, and then also we use the Kennedy as well. As you can see here, is first is the what is the Balan, and then the second one is the Kennedy. So our target, we lifted it toward that 78.6 level. So if you look at this tool on like the first tool, it's actually measuring the length of the third wave and then equating it to the possible length of wave 5. So we know that in an impulse, wave 3 cannot be the shortest. That means given that we have wave 1 longer than wave 3, we were expecting wave 5 to be like shorter than our wave 3. So this was now what we call Elliott's final channel. And then we thought the moment we go below it or trade below it, we should conclude that now this impulse to the upside is over. I mean, look at that. That's the 1.382 Fibonacci extension of a flat, specifically when we're targeting wave C. So we saw this candlestick to the downside, confirming that indeed probably our fifth wave of C has now ended, and we like ended at this famous Fibonacci level of 1.236, a very famous one for wave C of a flat after that 1.382. So again, if you look here, this is our fifth wave with wave 4 being a bit bigger than wave 2, but it's okay. It does happen, you know, once in a while. And I was just measuring and trying to show you that our wave 3 is basically shorter than our wave 1 here. So you shouldn't think maybe the rules have been broken. So another way of spotting that wave 5, you know, has ended earlier than, you know, waiting for Elliott's final channel would be like drawing a channel within wave 5 specifically, like that is on a micro time frame. Say you go to lower time frames here. So that breakout would have confirmed that indeed, you know, we're done now with wave 5 of C. But also if you look on the weekly time frame, the candlestick that we saw here did confirm, because we had a spinning top followed by a huge candlestick to the downside, forming part like of a bigger candlestick pattern that we know as an evening star. Because again, we didn't have a doji, we had a spinning top. So if it had been a doji, we would say an evening doji star. So again, breaking and closing outside the lower boundary of Elliott's final channel was a confirmation that indeed our wave C has concluded. Also, you know, if you remember, we reached, you know, a famous or an important Fibonacci level, which is another confirmation in this case. So if you check here, the MACD didn't really give us anything except for divergence. Sometimes you won't see divergence, especially with like, you know, the MACD. You'll see it on the MACD histogram, not really, because again, if you look at the black line, that's the MACD, and then the orange line, the signal line, like MACD signal line. On the RSI, we saw no divergence, but what I liked about it, the wave count was clear, and you wouldn't even be able to dispute the fact that divergence was missing. But the important point that you're going to find out about is the fact that even though we didn't have divergence, we actually had a point of confirmation that the uptrend is now over right there, that point highlighted with the circle. So it's very important, because this EMA right here marks the trend. So the moment you trade below it, it means now we are in an immediate downtrend. So a good sign anyway, you know, for someone who is still planning to go long. But also if you look at like the monthly time frame, what do you see? A doji, which indicates that now we have undecisiveness rather in the market, which is a very, very good sign. So it's following what? 3 white soldiers to the upside. Again, I want you to know that 3 white soldiers, very common on higher time frames than the 4 hour. That is starting from the daily and then going down. And then on the quarterly, what do you see? A black candlestick following this white candlestick. And then look at the Fibonacci levels. It closed below the 50. So we know that the moment you close, you know, like in such a pattern like this is what we call a dark cloud cover. The moment we kind of close below the half, in the case of a bear market, the half of the previous candlestick. In the case of a bull market, we close above the half. So in that case, it's going to be called a pacing line. So because this market is now a downtrend, this is what we call a dark cloud cover. So we use Fibonacci levels in order to measure, where did we close exactly. So a good sign. A lot of like technicals to confirm our outlook here. And again, it's like we're trading in real time. So look at these horizontal lines here, black lines. They are indicating zones of significance, or what we now know as, support and sometimes resistance, or you want to keep them in mind. And then we change to the Heiken-Ashi, again on the daily. So within the Heiken-Ashi, I barely use them. I think with you, I'm using them for the second time. The gray Heiken-Ashi to the upside are actually bullish, and then the ones that are red to the downside are actually bearish. Now, within the tops and bottoms of the Heiken-Ashi, what you are going to see is these doji-like patterns. Sometimes they'll be black. Sometimes they will have a color, maybe, gray with like a very, very small real body. So they are often considered doji. So they are often found at a point whereby the trend is actually changing, or the momentum is the lowest. But most importantly, when the trend is changing, look at the arrows there indicating to you that this is where we normally see the arrows that I'm talking about. Look at that. Very, very important points that you want to also keep in mind. Look at how many tools so far and how many time frames that we have used. I mean, we are still back testing, but you don't just like enter, place the tool for the risk to reward, the stop loss. You first have to look for the evidence that suggests that, well, your methodology is working here. Your methodology is guiding you to do this here. And then when you have done that, because again, it's important not just to look at the entry, the exit, but also what did your methodology say to you, so that next time when you're looking for trading opportunities, you first consult your methodology and then your plan thereof. And then after that, you consider everything else, which is like the trading business related stuff, like stop losses. When are you planning to enter? What type of an order are you planning to use? So this is a rare bar pattern that we call a single close key reversal bar. Basically, we have a bar to the upside that closes higher, and then the next bar most of the time will push higher, but it's not necessary, but close below the close of the previous bar. A very important part about the single close. A double close is just like a third bar that closes below the closes of the two previous bars. So again, if you look at that highlighted part, 5 waves to the downside, but on the line chart, the count is not really easy to decipher. Another important part about it. So I concluded that is the high, that 110.176, given that we could see 5 waves to the downside after all the evidence that we saw. Also, we see a series of evening stars right there. That's the first one with that arrow, and then another one which I already spoke of. And then we also see false ones. So this part, Jeff, was the first one to actually talk about, whereby I've seen it myself. It's mostly in wave 2 and 4, whereby you see these false reversal candlesticks on like the major corrections. So if you're trading on, say, the 4-hour, and then you will go to daily, chances are you'll see a pattern like this when you are like seeing a wave 2 in 4-hourly and you're looking at the pattern. Wave 2 is like whereby you'll see it a lot, but also in wave 4 it's there. But because wave 4 can be very, very big compared to 2, and 2 is normally brief, you'll really see them on wave 4. Anyways, I went to, again, higher time frames, which is specifically the monthly. We saw that doji, but also an evening star. So basically, this is an evening doji star. That's a mistake that I made there. So that's a sign of reversal. But you can see also we did, seek liquidity. Take everyone here who went, who went short earlier on. So went back to the lower time frames because I've been looking for all the evidence, and I'm still looking because again, for the tops, it's a bit more difficult to, spot the tops even with the wave count. Although Elliott Wave Principle is known as the best methodology out there, it's still difficult. Look at that, a trend line, you only require 2 points, but we even had 4. That's a trend line. So we broke down now, like that trend line actually broke down, or we broke below it with that huge candlestick, specifically a bearish engulfing candlestick. But if you look at that black candlestick alone, it's what we call a marubozu, often voluminous. And then we followed with this, again, correction, which didn't take out the high. That's very important. That black candlestick with a long wick, it's a hammer, but it's part of an evening star. Again, we know an evening star is a bearish signal. So that's typical of wave 2, but I like the fact that it was moving towards the upper trend line, which is now sort of what we call a pullback, in other words. And then if you look here, we reinstated that is a previous support level. So again, we see it offering that bit of a support even now. But look at this pattern closely. This is what we call head and shoulders. Very common now. It's mostly formed within the wave principle by wave 3, 4, and then 5, and then A, B. So that's what we get to see here. But in this case, you didn't really see the typical retest that you'd normally see. And if you look at your wave 2, because our wave 2 was very deep for the decline, and it's really close to the high of wave 5 right here. This is what Jeffrey Kennedy would normally call two-headed monster. So if you look as well at like the the right shoulder, it's a bit smaller. It didn't reach the upper boundary of this Kennedy channel right here. So this is called the half shoulder. Sometimes it can happen not only on the right but also on the left shoulder. Even on the two-headed monster, one of the heads will be small, especially in the case of a truncation, but really so. But most importantly, when our wave 3 didn't retrace deep, so we didn't see, after the breakdown of the head and shoulder, the typical retrace back to the lower boundary, because our wave 3, as you can see, just below 106, it became very powerful. Look at those two circles up there, a typical double top chart pattern. That's another thing you want to consider. Again, this is a back test, but what do you see? A lot of emphasis on the technicals. 5 waves on the line chart are visible. Now, why a lot of technicals being used? Well, for you again to enter, for you to exit, that is decided by your technicals 99.9% of the time. Sometimes let's say you will set your Fibonacci levels and all of that, but if you'll see now the market is moving against you in a voluminous way, sometimes you'll consider exiting. Look at your wave 2, very deep. What is the cause of that? Optimism. People thought the trend is still continuing, something you'll mostly see when like the trend has been going on for a very long time, specifically an uptrend. We even exceeded that 85.6 Fibonacci level. So I would have entered at that star right there. My stop loss just there above that 110.176 level. So the take profit would have been far. We know that 1.618, that would have been the take profit here in this case, because again, why? We're dealing with the wave, the third wave here. So that's where we would have placed our our take profit for like a short position if we were shorting the dollar index. But it's something I never trade. Look at that. A second entry might come out of there, given that we had this trend line to the to the upside, so that we were waiting for the market to break out to the downside. A second star, that's what we call now a Kennedy entry. The first star is what we call a balance entry. Again, it uses the Fibonacci levels, well detailed in his book, Elliott Wave applied to the foreign exchange markets. You can download it even online. It's out there. Just buy it. I prefer that. So again, you are looking now at like the Kennedy entry. So most of the time I like to enter 2 trades, because why? Wave 3 can extend quite a lot. It can extend quite a lot. So I want to catch as much profits as I can in this case. So I was like planning to use the Kennedy entry here, or technique in this case, like to catch or maximize my profits. So what you are seeing right now is me planning, thinking on how would I enter these trades? Is it the market execution orders, or stop or limit orders? Because sometimes you won't be there. So again, so that you don't make rash decisions, I believe like pending orders are really like a way for me to go about it. So there I was planning on how I do it. I mean, I do it in real time sometimes. Even yesterday I did it like that. So this is me now planning my stop loss, planning like my entry, and then my take profit, because again that's very important. So in the case whereby I'm expecting the third wave, sometimes I like to keep my target open for the scaling trade. So the second entry or star is a scaling trade, because again I said wave 3 can extend. So look at that. Why do I also keep it open besides the fact that it can extend? It's also because of the poor risk to reward. So this is what I added: a 110% retracement of wave 1. So that's basically where we would like confirm whether this pattern that's playing out is a zigzag or the third wave. So a third wave will normally exceed that 110%, but a zigzag, because that wave C and A tend to be equal. If we see a rebound, or let's say resistance around that level and back towards let's say or deep within wave B per se, we often know that's a zigzag. That does not mean it might not be a zigzag of a diagonal or something like that. So I planned here my stop loss as well, because that's very important. But now this type of a trade, because I was testing it for actually the second time here, like on say on higher time frames, it works well like when I'm doing intraday. So I came up with, because like this one failed, you're going to see as it actually plays out, it failed. So I thought it's actually not good sometimes to use it the way I used it here. It's better to consider it, say like in an extension, or like an extension within an extension, rather than the way I considered it here. So I will make a video to actually explain that part here. So that's the third star right here. I want you to note that's the pending sell order, just like the second order. Now the stop loss is where I want you to look at it very, very closely. The stop loss is where here, so that you will see where my mistake was actually. I think I did it really, really, really wrong. You see, like, just look at that. So the second trade now, it's risk-free. We shifted the stop loss. Very important to consider. Again, the third trade, we call it 2A. So what do you see? What do you see? You see pending sell order right there is now triggered, because we did reach that 110%. Look at that. So we were taken out. So if you look at that wave 4 and 1, there's an overlap there that could have alerted me that we're having a further extension, because wave 4 and 1 cannot overlap. So I should have shifted my stop loss down or up, depending on the risk appetite in this case, because normally I don't risk much on that trade. I can risk about 0.25%. So again, I thought it's either I eliminate this trade or consider it within a third of a third, which is the most powerful portion of like a wave, specifically the third wave. So again, here it took a loss, but then given that we extended beyond that 1.618, the like the running trades actually covered up, specifically the second trade. They actually covered up for that loss of 2A, because I can remember the first one, the initial target was 1.618, and we did move past that. We're now at 200% extension, so it has closed. We have now one trade that is running, which is also a risk-free trade in this case. So that's very, very important. We should lift our stop loss. This is now what we call the trade management aspect, or risk management aspect of trading. So we have that 1, 2, and then we also have this extension within wave 3. So we are seeing what we now call a 1, 2, 1, 2. Hence you see that minor pullback here. I believe that's wave 3. right about there. So wave 3 and 4, wave 4 is actually the one that is coming, given that wave 3 reached the 200% extension. So I thought, you know what, chances are we're going to see a minor pullback that should not reach that 105.531 level, which is now a good level for us to place our stop loss. But also consider our wave 2 was a sharp pattern. The guideline of alternation warns us that we should expect a sideways corrective pattern, given that our wave 2 was what? Again, it was sort of sharp, which is a zigzag that we clearly saw here. So I looked there are your fibs, which is also a good thing, by the way. You didn't even reach that 38.2 Fibonacci level, so a flat. So now again, you don't just look at the retracement levels when you're about to enter a trade. You look at like more compelling evidence, either against or in your favor. Now, the greatest mistake Elliott Wave analysts make is just looking for evidence that supports their wave count. If you're bad at wave counting, you'll be bad at also looking for the evidence. So look at that. Again, the guideline of alternation, well stated there. And then look, this level just below us, which could be the level where wave 5 of 3 actually ends. So we're also considering that. Look at the candlestick patterns that are out there, playing out, even that we didn't even like reach that 38.2. Look at this resistance level offered by that 20 EMA right there. But also look at the fact that we're trading below the like Donchian average. So I tried to look here on the weekly, but I didn't find much evidence, which is why I quickly went back to the daily. But look at what we find here on wave C this is what we call now 3 advancing blocks. It's basically more of what we call 3 white soldiers, except that instead of like the candlesticks increasing in size as the market pushes higher or lower, these ones are actually going down. So it's a sign of weakening momentum in this case, which is like a good way of confirming that wave C is coming to an end. Then what do you see here? A white candlestick, and then the next candlestick retraces almost 100% of it. So you can say that's a dark cloud cover, because a bearish engulfing, at least it should be equal to the previous candlestick. But also look at the black candlestick that opens after the black one, which is now what you'd say it's a 3 inside down. Normally a 3 inside down, it considers a harami. So again, that's a harami right there. So I thought, given that we have a candlestick pattern that we recognize closer to the Fibonacci levels, we saw a sideways pattern, why not enter here instead of just focusing on the fact that, hey, we should reach a famous Fibonacci level, which we fail. We did reach the 23.6, but then the 38.2, it's not really a necessity to reach it. So an entry is okay here. A 50 level is okay also as a stop loss. Why? Because we didn't even reach the 38.2. So should we have reached the 38.2? I think we would have used the 61.8 as our stop loss, as Balan normally suggests. Again, just adjusting what he said, in order to suit my trading style. Also, there's no sin in that. So again, look at the risk to reward. Not really good, but again, scaling trades sometimes, because you don't really use a bigger lot size, you're just scaling in. I can like tolerate that 2:1. So I also considered that wave 5 might not actually be extended, given that our wave 1 was extended. The guideline of alternation says if wave 1 is extended, you expect the other 2 waves not to be extended. So sometimes what you saw is wave 3 actually did it like moved the normal 1.618, but look at wave 1 had these exaggerations like in terms of subdivisions. So that's like sort of a characteristics or say of an extension. So I put that at the back of my mind. So I thought maybe wave 5 might actually be shorter than wave 3, and say wave 1 is semi extended. That's another thing. Hence I wanted to set my TP at that 78.6 also, which is a zone of resistance. Again, evidence-based trading. So I made the biggest mistake here. I focused on the candlestick momentum, and then I said wave 5 has actually like bottomed. But that's wrong. If you look at the internal wave count, we have 1, 2, and then this deep wave 4. We don't have actually 5 waves. We still have 3 waves, 1, 2, 3, and then wave 4 is still unfolding. So I focused now on what? On that level, support level, but also on the momentum. Look at even the price gap. There's also a price gap there, like on the third wave of 5. Now that's called an exhaustion price gap because it's wave 3 or 5. I mean, in wave 5, the market is often exhausted. So I was expecting wave 4 now of this entire rally to say play out. And oh boy, I was wrong. I left a lot of profits on the table because that deep retrace was only going down to do what? To close the gap, which is the exhaustion gap. So that's another mistake I learned while I was doing this. So basically all of this that you're seeing right now, yeah, you think that's correct, but actually it's wrong. It's actually wrong. Inserted the lines for the Kennedy timeline technique, but you're going to see something that is also going to shock you, as it did to me. It did actually shock me quite a lot, but also you can learn what I just did using those 2 lines there to draw what we call the Kennedy timeline technique. It's a technique developed by Jeffrey Kennedy. As you know him, he's a great fan and a lover of the wave principle. He's been at it for like 30 years now. So I thought within that, okay, sorry about that. So I thought within that blue box, we are actually going to see a reversal of the 4th wave or the bottom. But look at it, wave 5 was not over really. That was literally wrong. So if you look at the line chart, it's actually confirming wave 1, 2, 3, and then a deep 4, and then wave 5, which is actually the one that was like still unfolding. So which means everything that we just did, every effort for the Kennedy timeline technique, KTL to see, is wrong. So that's now our wave 5 that was still looking for. You are going to see also a phenomenon which I also love within wave 5, because again, I literally ignored it as I was trading this. I also didn't mention when I was doing the notes for you here. So look at this very, very closely. You saw that wave 3 was what? Was extended, but not only that. Wave 3 of 3, when we're talking about that head and shoulders, didn't even have a pullback that moved towards the lower boundary of that Kennedy channel. So which is actually a sign that wave 3, 1, it had like a lot of volume and a lot of momentum, but most importantly, it moved too far, too fast. On top of that, what happened? It was actually extended. So what comes to your mind when you talk about all of that? Well, we are going to find out. I'm going to remind you. So this is now actually the 4th wave we've been waiting for. We failed again to reach that 38.2%. And what I like about it is that we peaked within that range of the Kennedy timeline technique, which is still a good thing, although we didn't touch the important Fibonacci level. So one of the things I highlighted is that we like to see a zero line reversal within wave 4. And it's mostly the time frame that you are in, like that's where you'll find it. And there it was, whereby the black line for me, or zero line reversal, reverses towards the 0 level of the MACD. It doesn't have to be exact, but closer to it is just enough. So look at that, a trend line right there, a break below it, it's a sign that the correction is over, or maybe the A leg is over, or the W leg in the case of a deeper retracement is over. But look at that as well, a single close, but also we're finding that resistance now where at the previous support level. So it's what we call a change of polarity in this case. And then we see these candlesticks right here, 3 of them. Normally you'd say it's 3 black rows, but that's wrong because you can see they are decreasing in size. So this is what we call 3 declining blocks. So again, it's just a bearish signal in this case. So what do you see? A harami at the level of what? Of that resistance. Remember, previously it was support, now becoming resistance level, which is now what we call change of polarity again. So another compelling evidence that indeed we have more evidence, or like a pending decline Now that does not mean it might not work in the other way around. So there it was like my target, profit target. As you know that most of the time wave 5 will reach that 61.8% extension of like a move from wave 1 till wave 3. So look at this. Now the price action is actually having this slope that is shallow. That's the first thing I want you to note. A shallow slope. So it didn't really cross my mind when I was trading it because I was so fixated on the lower time frames. But also I thought maybe wave 5 will extend in this case, because again people have fear of of a change of trend. It can happen. That's why you see a lot of extensions. Now if you look closer at this pattern that is unfolding, it has a lot of overlaps. So that's clearly not an impulse. And we know that diagonals are found in wave A, wave 5, wave 1, as also wave 3, as well as wave C. So on wave 5, wave 3 was what? Was like very powerful. It was extended. And we know that when wave 3 has moved too far, too fast, what do we tend to see? We tend to see ending diagonals. Remember, I said to you on that head and shoulder pattern, our wave 3 didn't even bother to go back and retrace. That's how powerful it was. So that's another thing right there. But also, if you look at these trend lines right now that I'm going to extend, this should have been a warning that, you know what, we're breaking like above now. It can no longer hold. So we can't be expecting any further move to the downside here, which means that indeed wave 5 has completed even before reaching that 0.618. Normally it's between that 38.2 to 61.8 Fibonacci extensions. So this should have concerned me right away. Again, sometimes fixating on the lower time frame so that you can navigate all the complexities can actually, get the best out of you. But most importantly, we know that wave 1 and 5 tend to be equal if wave 3 is extended. But also there's a famous Fibonacci level that Robert Ballan mentioned, that wave 5 will often, reach that 1.618 level, or like specifically it's an extension of wave 1 instead of that normal equality that we tend to see. It's like Balano mentioned it. It's very important. In fact, I find this one being like, say 40% common, as like I would say the equality one is 60% and then this one is 40% equal. It's very common actually. It's very, very common. Rarely will you see that one whereby wave 5 is like equal to the 61.8